So let's kick things off. Thanks everyone for watching, and thank you to Will and Ali, who we have here from CoVenture.
Thanks for
Love to
having us.
just kick. What's that?
Thanks for having us.
Yeah, absolutely. Glad you could be here. So why don't we just start? You can give a brief intro, both Ali and Will, and then love to hear about the story of CoVenture and what you do there.
Sure. So at CoVenture, we do two types of investing. The first and potentially most relevant for this audience, although they both could be relevant, is we do venture capital investing. So we have a venture capital fund, and we invest out of it in early stage technology companies, usually ones that are touch fintech in some way. So sort of any financial services innovation. And that can be kind of true hardcore fintech like payments or cyber or KYC AML stuff. Or it could be sort of new types of capital markets. And we love credit, we love origination businesses, we love sort of new platform economies that are being built on things like YouTube or Amazon or Spotify or Shopify, anything that sort of helps the monetization engine of those platform economies. And then in credit, what we do is we provide debt financing to companies that have sort of uncovered one of these novel asset types or some sort of new type of financing or loan, and we'll give debt capital secured against those assets. So we don't do venture debt, we don't do corporate lending. All the debt capital that we invest is sort of asset-backed credit, except the assets that we finance are traditionally tech-enabled or sort of uncovered by a technology company. So, Will on the call as well works on the credit team. I sit across both, and that's generally what we do at CoVenture.
Got it. And so are you one of the co-founders of CoVenture? Is that right?
Yes.
Great. Will, do you want to do a brief intro about yourself?
Yeah, sure, happy to. So I'm Will. I work on the credit side of CoVenture. My responsibilities include portfolio monitoring, so helping make sure that our companies are performing. As you know, on the credit as opposed to venture, a lot of what we do is focused on protecting the downside. So my job is focused on kind of risk management and protecting the downside. So that's where I focus a lot of my time on. I've been with CoVenture for a year now, and just mainly focused on kind of the credit side there.
Fantastic. Well, great to have you both here. So to kick off the conversation, I'm sure many people are wondering, how has COVID affected the venture landscape and the credit landscape? Would love to hear kind of just some of your thoughts on maybe what you've seen on how it's impacted the venture landscape generally, and maybe more specifically, how have you seen that affect investing at CoVenture?
Sure. So, it's already had different sort of stages of effect. So in March and much of April, almost every day was just board calls, board meetings with management about how to cut costs, about how to raise bridge financings, about how to put more runway in a business. What's unique about venture capital compared to other asset classes is both good companies and bad companies by design lose money every month. And so if you had 10 months of runway, you could be a great company, but you weren't just thinking, oh, gee, let me just wait 5 more months until I have 5 months of runway and hope things are better. You just had to go out and raise. And that was really challenging, and valuations were super low. I mean, I probably had 50 to 80% discounts compared to what I would see companies normally raise at if you had to raise in March or April. And that was really tough. And on top of that, you had a lot of venture firms saying, okay, here are the companies in my portfolio that are severely impacted. And certain businesses were down 90, 95% in revenues because they might have been a live events business or hospitality related or otherwise. Mm-hmm. And those needed immediate bridge financing. And a lot of other companies needed capital to just sort of give them more runway. And I think now that people have sort of started to calm down, they're realizing a couple of things. The first is more of their fund needs to be used for dry powder than it was before, or sort of follow-on investments, which means they'll probably just have less total deals in the fund. And then I think the dilemma a lot of people are wrestling with is sort of this like growth versus preservation of capital dilemma, which is, you can either preserve capital and have a longer runway, but that might hurt growth. Or you can spend money like you normally would, and growth will kind of be what it should have been, and you're risking capital markets. And the challenge is trying to figure out at what point are you spending so little money that despite the benefits of a longer runway, you won't be able to hit growth targets that no matter how long you survive, you're just not gonna be able to raise. And a lot of third-party financings or new sort of venture capital rounds are really done on the back of growth. And growth is sort of this like, potentially overstated metric that venture investors use, where if you're growing over 100% year over year, and mostly talking about Series A and Series B or growth rounds, you can raise from any valuation from any firm. And if you're growing at 50 to 100% year over year, you can probably raise, but it's hard. And if you're growing less than 50% year over year, you can't raise, or your insiders are gonna have to do the round. And so I think a lot of people are trying to figure out like how much can they really cut costs without getting themselves to a point where no matter how long the run really is, the growth just isn't gonna be there. So maybe that's my venture hat. And then I guess, and then the last thing I'd say is, things have started to come back. We have one company in our portfolio that, they've done tremendously well, and they got a term sheet, not long after kind of launching, at a valuation that would have been a pre-COVID valuation. I think they're negotiating it a lot less hard, but there's still capital out there, and VC firms are pretty well equipped with dry powder before this. So things are starting to come back. Will, did you have any sort of commentary on credit that you wanted to kind of speak to?
Yeah, I will add that I think an important question that we will ask, after COVID has happened, every time we look at a new investment is, how was your performance during COVID? And I think as investors in general, as venture capitalists and as credit investors, you always wonder, how is this company going to perform, in a stressed environment if the world, if the world came to a stop. And that's more or less what happened during COVID. So I think, from a credit perspective, we'll pay especially close attention to, companies' data, companies' performance data through this period. And, there's going to be companies that come out winners. People who demonstrate good performance data through COVID will make themselves stand out. And I think in general, COVID's given us, as investors, doing diligence, a really good kind of case study to see how individual companies performed through a stress period.
Yeah, and I think what you'll also find, to Will's point is, okay, so the ones that do well during this feel like they'll do well anytime, and it'll be sort of this like potentially for many companies sort of tailwinds that come out of that. I think where we are, and this just isn't just in venture capital, it's in the stock market, it's everywhere, is you've really seen investors go to two corners of the room. For 10% of the world, that something totally is gone, right? Like hospitality is gonna be really tough, live events is gonna be really tough, sporting events is gonna be really tough. But like 80% of the world, no one has a clue. And then there's 10% of the world that everyone's got a lot of conviction that it's probably gonna be fine. And so you're seeing, and people have capital, so they have to put it somewhere. And so you're seeing people really, really bid up assets that they can get conviction around. And that ranges from Amazon stock and Alphabet stock to, telemedicine and teleconferencing and work from home remote startups. And so, there are corners of the universe where it's insane. Like the asset prices are way too high. I also think the other thing that's hard to remember and easy to forget is that things just take time. And in credit, defaults take time. People have raised all these distress funds and dislocation funds. And I think we're like in a dislocation bubble. Everyone has a dislocation fund. And I think it's just going to take, it took 2 years for default rates to get to their peak in the last recession. And we're still really, sort of early on. And then, one more thing that I thought was a little interesting in the credit world is, normally you think short duration assets are really great because, I don't know what's going to happen 4 years from now, but I can kind of predict the next 90 days. And so if I make a 3-month loan, I should be okay. In this case, it was a little different because if you made a 90-day loan, and someone missed 3 payments, that's all your money. If you made a 5-year loan and someone misses 3 out of 60 payments, you can kind of recover from that. And I think the other thing that's going to be an adjustment is, the government has now proven through 2 recessions in a row that it's pretty good at saving big companies and bad at saving small ones. And so I think a lot of people are going to try to attach themselves to platforms. And that might be small businesses trying to attach themselves and get more ingrained with places like Square or Amazon. Like Amazon sellers are probably fine. Instagram influencers are fine. And so I think you're going to see a lot of the economy try to attach themselves to these platforms in a bigger way as essentially an insurance policy going forward. And then the last thing, sorry, I'll pause in a moment, is everyone might be thinking, okay, thanks for all the problems, now what do I do? And I think the number one thing you can be doing is having just aligned incentives with your existing investors to know what success means for them and just be on the same page of what's it going to take for them to write another check. So, okay, so we now know we have this growth dissonance. We can either extend runway or grow faster. And I think you just need to have a conversation with your board and say, what would you guys want us to do? What's success for you? And what do we need to do for you to write us another bridge check that we can't go out to the market again? Sure, I'm happy to cut costs, but it means that my growth might be 40 to 50%. Are you willing to write the next check again so I can re-ramp growth? And if the answer is no, then you have to keep growth going because you can't rely on your insiders. And so I think a lot of it's just internal communication.
Mm-hmm. Mm-hmm. Yeah, I think that makes a ton of sense. And you touched on a few points that I might want to get back to in a bit. And that's kind of this tension that you mentioned between managing costs and cutting costs, while at the same time, how do you continue to grow and manage that growth, as well as aligning incentives with your investors. Love to touch on that a little more a bit later, but given that we're now on maybe month 4 of COVID, have you seen any type of changes in sentiments from investors? Back in March or April, you might have seen like people being like, well, we'll have a vaccine quickly, like we'll find out this isn't such a big deal. But here we are 4 months later, and we're like, we're probably going to be shut down until maybe early next year, who knows when. So we're kind of accepting this as a new normal. Have you seen that really affect investor sentiments at all?
I think a lot of it's just sort of a black box, and in the spaces that are hard to predict, there's just not a lot of deal transactions occurring. I think in things like, in certain industries or certain asset types, people say, well, this seems bad, but it'll eventually come back. And you saw Apollo and Silver Lake and Owl Rock and a bunch of these sort of big lending firms make pretty sizable loans to these companies, knowing that this is sort of a temporary blip in time. I think things that but a lot of stuff is just in the who knows camp. And so the bid ask is so wide between what venture investors are willing to price something at compared to the optimism of the entrepreneur. Both are natural, that you're just seeing things not clear. And I can imagine there's gonna be low deal transaction volume in anything that is not already either humming again or clearly just distressed. One of the things that I've been talking to our investors about is there's not a lot of distress right now. There's just a lot of black box. So, in our world, if someone comes to us, they're saying basically, here's a bag of shit, and I don't know what's in the bag. It's probably pretty bad. You want it? I'll give it to you for a low price. And that's not that interesting. There's nothing where it's like, all right, the thing went bad, and now we know it's left. Let's go buy it, in pennies on the dollar. That'll probably happen, some time from now. There might be some more acquisitions, talent acquisitions, stuff like that, but we'll see.
Yeah. So at this point in the year, are there any particular trends that you might be seeing, speaking very generally, not necessarily related to COVID, in the investing landscape? And then separately, or in addition to that, any particular industries or verticals, technologies that might be exciting to you right now?
I think generally things like e-commerce and direct to consumer are probably doing reasonably well, especially because, there has been such a shift from offline to online. And that struck us as pretty surprising. I spoke earlier about, okay, so it seems like a lot of these businesses are now trying to go to these platforms. So like I can imagine a Zoom economy becoming a real thing, where you have professional services individuals trying to teach classes on Zoom and trying to kind of build a livelihood out of that. But I think a lot of things that just had a lot of friction before, this was finally like the catalyst of, okay, we just need to do it. So like there's a company called Notarize that we are not invested in, but this is all public information. Like they've been growing like nuts. And you used to have all these sort of curmudgeonly law firms thinking, well, we want to have a wet signature and notarization. And it turns out you can do it online. And this is just like a forcing mechanism. The same with telehealth. So I don't know that there's anything like mind blowing. I think we're trying to stay away from like COVID trades where the company is successful because of COVID, and without this catalyst, the success would be wildly different. I think we're just trying to kind of keep our heads down, and we're trying to avoid things that, if COVID stays sort of materially adverse for the next 24 months, we probably won't touch it. But things that can survive, better or worse, generally okay in a COVID environment. I think the other thing that's going to be really interesting to see is, is going to be SaaS contracts and how many of those get renewed. When you're cutting costs, what stays and what goes. I think the other thing that we're kind of spending a lot of time thinking about is sort of the flip of the consumer capital stack, where it used to be that you used to think auto loans and home loans were sort of the first thing you'd pay. And I would argue, I think Spotify subscriptions are probably going to have lower churn than auto default rates. That's sort of like an odd thing to see. And it turns out like the size of the payment matters a lot. So yeah, I don't know.
Yeah, that's really interesting. You say that the auto and home loans versus kind of Spotify payments. I guess that's something I hadn't considered before. It's fascinating to think about what are consumers willing to forego and kind of be in more of a
I think people
beg for mercy kind of situation. Go ahead.
The thing that people are spending a lot of their time figuring out is like, how much am I paying compared to the utility I get out of this thing, right? And like, if Spotify doubled its prices, I bet you'd all stay on it. I think the other thing is, for many people in the United States, if you have your job, you have more cash than you've ever had. You're going out less. You're spending less on, nightlife or whatever else might have been. And so, I bet you, of anyone listening to this, the amount that you're spending on streaming or subscription services today, for almost everyone in the room, is probably like double compared to what you were 4 months ago. And we were already, by the way, in like a content bubble where you had Amazon and Netflix and Disney and everyone and YouTube and everyone bidding up content. I think for creators, it's going to be massive. I mean, this is a huge windfall for them because that capital is going to flow into Netflix, and Netflix is just a financing company, right? If you look at how a lending company is built or an insurance company, first you figure out how to originate, and then you figure out how to underwrite, and then you become the capital. Netflix, first you figure out how to originate by sending DVDs to your home and then doing streaming. And then they wrote you by having these algorithms and recommended. And then they became the capital provider and producing the content or buying the content, right? And so they're just like this, they're basically just a financial business that happens to do content. And so, they're just going to have more and more streaming revenues. Those streaming revenues aren't going to churn. Their stock price is high. One of Netflix's biggest advantages is how high its stock price is. So it can go buy a ton of content. And that's going to continue to happen.
Gotcha. So getting back to one of the points that you're making earlier, kind of about the managing this tension between cutting costs and continuing to grow, what are some ways that companies could really stand out to prospective investors or existing investors, who might be interested in follow-on funding? Are there any specific metrics or qualities that you're looking at more closely now in that way?
Capital efficient growth for sure. I think it used to be okay if you're growing 100% year over year, no matter what. And now it's like, are you growing 100% year over year because you're spending a crap ton of money, or because you actually have a capital efficient business? And I think being pretty disciplined about how you're measuring the ROI of every dollar spent is really important. And so, look, there's companies in our portfolio that have really low burn, and it's like a luxury, and they may actually get to profitability and build their business off of profits. And it's going to take them a really long time to get there, but those are pretty exciting meetings to be in. You're in control of your own destiny. I think a lot of firms are going to be really worried of this sort of game of musical chairs, where let me give you money, so the next person gives you money, so the next person gives you money. So it's not like I'm saying anything sort of super controversial or contrarian, but I bet venture investors are traditionally pretty bad at using data. They basically use things like revenue multiples and SaaS multiples and CAC to LTV because they're these really simple fractions that they don't have to use Excel to figure out. So I bet you there'll be some new, ratio that somebody famous on Twitter tweets out, and all the young VC associates run around saying it's their comment, what I really think is we really should be tracking this other metric, and it'll probably be something, around capital efficient growth.
Got it. Will, do you have any comments on maybe from the credit side? Anything that's changed since, COVID started? Similar type of question as I just asked Kali.
And Will, maybe you want to talk about how managers and operators are thinking about pulling back credit and risk or pushing it up, trends you've seen in sort of data, how people, all that stuff.
Yeah, I will say that, as credit investors and as credit allocators, one of the things that we struggle most with is deployment. So, are companies able to originate? Are they able to kind of find assets that we've underwritten and actually deploy money in these areas? And I will say that, during COVID, what happened was a lot of companies came to us and said, this is an uncertain environment. We're not sure if we should be deploying, all of our money into an area right now. We'd rather hold a lot of cash on our books rather than hold a lot of assets right now. And that's kind of a problem dilemma that we struggle with, where as allocators we want them to kind of deploy money into assets, but we don't want them to take an action of a risk on action. So I think it was more of a kind of a slower deployment schedule through COVID. And now that we are kind of on the back end of this of the trend, we're seeing that our originators are deploying more money into their assets.
Gotcha. Moving to a similar type of question or topic, when companies are looking for either venture or credit opportunities, what should they be looking for in investors right now? Maybe this is more of a venture question, but as companies are seeking funding, investors are still looking for what do I do with our dry powder in this uncertain time? How should startups be kind of thoughtfully approaching who they're talking to for investing opportunities?
So, I think one, you want sort of stable partnerships. And whenever there's sort of this sort of catalytic type shift like COVID's creating, you're going to have churn in partners, associates, operators. And if you took a round of capital and the partner that led the round isn't there anymore, and you're in one of these sort of emotional and anxiety creating situations where you had to pick which companies you're going to work with and which ones you aren't, people defend the companies they're on the board of, because when you're on the board of a company, you have this sort of like emotional tie to it, this feeling of obligation and responsibility. And it's really hard to tie in your fiduciary responsibility as a board member versus your fiduciary responsibility as a manager of a fund. And those lines get blurred. So I'd be very careful making sure that you're trying to take capital from someone who's been at the firm for a long time and will continue to be. I think a lot of it is, this venture has become this sort of sales game where there's a lot of salesmanship and talking about how great a founder is and how great a company is. And you should be looking for people who are pretty blunt and pretty aligned on what they're expecting to see and what they like and what they don't like. It's been pretty odd. A lot of founders are so used to everyone telling them that they're great that like the first time they have an honest conversation, they think, wow, this guy's a jerk or this gal's a jerk. And I think you got to be really, you want the honest feedback, because this is not a time to kind of hear what you want to hear. The other thing is where a lot of founders, the biggest mistake I've seen founders make recently is they go out and they tell people what terms they want the round to be on. They say, well, we're really expecting something of X valuation. It's a really bad idea because one, I know you think that like you're like setting the market, you're not going to take no one's shit and like no one's going to cram you down. But like worst case scenario, you turn somebody off and they're like, oh, I'm not going to hit that valuation. So then you had to offer them something lower and you don't look good. Or they were going to offer you something higher anyway. And so you shot yourself in the foot. So I think, often VCs will try to get an entrepreneur to put out the first bid because that's a negotiating tactic. I think it's a great time to just say, look, like you see more deals that are happening right now. In a normal environment, I would try to do that, but I'm just sort of leaning into humility. I'm going to see what the market gives me. And you should not be surprised if you get a low valuation, and don't react. Don't sort of make I hope it doesn't happen. And for many companies, it's not, but it's we've seen a lot of people sort of not wrap their heads around the fact that like this is a time to be a little bit humble about the capital raise.
Yeah, I appreciate what you said about kind of
me to say, by the way, and I don't mean it that like we've definitely bid up on things in the last couple of months. So it's not all the companies, but like I know my portfolio companies that have screwed up their capital raising the most are the ones who went out with a shtick. instead of just letting the market tell them what to do.
Got it. Got it. Yeah, I think what you said about leading into humility is really really important. Hopefully, a lot of people take that to heart, especially no one can predict the future. Being humble when you're talking to people and accepting kind of their bluntness as more honest feedback. That's I think that's really valuable advice.
We just don't have time to not be honest. One, no one has a lot of time right now because they're dealing with a lot of stuff. So I don't have time to spend the first 20 minutes of a 30-minute conversation trying to sell somebody. And then B, like, it's just good to know what people are actually thinking because you kind of need that information.
So we're coming up on time here, but I think where I'd like to finish off the conversation, maybe two questions actually, one specific, one more general. Do you have any advice to companies who maybe are looking for early stage funding or financing in this environment? And then more generally, anything that you wish I had asked, any kind of parting thoughts that you might want to give?
Don't let COVID be an excuse for yourself. If people aren't buying your product or you can't raise capital and you've had a lot of investor meetings, it's not COVID's fault. Deals are happening and they're clearing, and you should just be honest with yourself and don't let COVID become a excuse unless you want to fold the business and you need to tell your friends something. And that's not true for all businesses. I mean, there are certain industries that are severely impacted. If you're trying to sell financial products to hotels, then yeah, it's probably COVID's fault. But good ideas are still getting funded, and don't put like these goggles on of, I'm sure my thing is really great, but geez, because of COVID, I couldn't raise money. It's a little harder. But if maybe you could have raised in a non-COVID environment, but if it's a good company and there's conviction, the deals are still happening. So don't let it be an excuse.
Got it. Will, do you want to have the last word?
Yeah, happy to. So I would say something similar to Ali. I would say be persistent. I mean, good deals are still being funded. Be flexible. Be determined. I think it's a little bit of a unique environment, but I think it's accelerating a lot of trends in the tech and funding spaces. So be persistent. There's opportunities out there, and we'll make it out from this.
Yeah, and a couple really tactical ones just to end it. The first is try to sell to people who are not in your normal geography. You'll be able to sell to them later. So take advantage of the fact that like where you are geographically doesn't really matter right now. And so if you are based in New York, sell to people in California, or sell to people in London. And on top of that, the tricks that you should use is if you're in multiple markets, the best way to get the most calls in per day, do your London meetings at 6 a.m., 7 a.m., and 8 a.m. Do your California meetings at 5 p.m., 6 p.m., and 7 p.m. because those are business hours in both those places, and like really work on your time zones. It's a good time to hire. It's also a good time to pick spots where big companies aren't willing to take risks. So one of the great advantages of a startup is you have low opportunity costs relative to incumbents. The classic innovator's dilemma stuff where, big lending companies, for example, in our world are going to pull back right now because they have a lot to lose. You don't have as much to lose. So you might as well try to take market share. So I would try to, use the competitive advantage of less to lose than a big company to try to really attack them hard where your spots make sense. And being super close dialogue with your investors, make them part of the decision-making process. So if things go wrong, don't hide bad things. Don't refinance people just to refinance them so there's a problem later. And in many cases, if something was already going wrong, cut it out now because everyone will blame it on COVID later. And so use this as a time to cut baggage. It might be, a contract that wasn't going to go through, whatever it is. In a year from now, when people are looking at your numbers and your numbers in Q2, Q3, 2020 suck, they're not going to think it's because of your company. They're going to think it's because of COVID. And so if there's anything that's not even related to COVID that isn't going well, use this as the moment to get rid of it.
I think that's a great note to end on. An optimistic note, looking at COVID as an opportunity to improve. So again, want to thank both of you. Thank you, Will. Thank you, Ali, so much for participating in this. I think there's a lot of valuable nuggets that we've had in this conversation. So really appreciate your time and your thoughts. If anyone wanted to get in touch or find you on Twitter, where might they be able to find you?
Yeah, I mean, my email is ollie@coventure.vc, and I don't really have a lot of hobbies, and I'm not allowed to leave my home, so I'm kind of around. And I respond to basically all emails. Will, I'm going to call you out. Will's is basically the same type of email as me, will@coventure.vc. And then, we're on Twitter. I only 60% believe anything I tweet, so don't take me too seriously on there.
Awesome. Well, thank you so much. Really appreciate your time, and hope you have a great rest of your evening.
Awesome. Great. Thank you so much, and good luck to everybody.